What's up you guys, it's Paul here and welcome back to my channel. I wanted to give you a quick update on NAT stock. A couple of people have asked me about it, about the previous strategies that I suggested and if it was still worth using those strategies to collect a monthly premium. And so I just wanted to give you an update on that and what strategies that I'm using right now to continue making a monthly income from it, okay? So as you can see, NAT is up about 3% today, down another percent after hours, but it's pretty much just a bounce from yesterday when it fell as low as $3.50 here. So in my honest opinion, guys, I don't really see it bouncing back up to $7-8. I don't know what's going to happen a year, 2 or 3 years down the line, but as of now, or at least in the short term, I'm not really expecting the price to go up. But here's what I'm actually doing. If you look at the monthly options, well, 18th is just not too far away, but if I look at the monthly options, which I talked to you about before, previously I was selling what are called covered calls. And so since I own 500 shares of NAT, if I sold, I could potentially sell 5 of these $4 calls and collect about $112 in premium, okay? So that's the covered call strategy that I was talking about. But then the point is you need to choose the strike price of the call that you're selling in such a way that if you get assigned on those shares, then you should be willing to sell your shares at that price, okay? Now, my average cost basis is around $5, so if I get assigned on these $4 calls, I would be selling my shares at a $500 loss, okay? So that I don't want that. So what I could potentially do is I need to choose a strike price of at least $4.50 or $5, which is closer to my average cost basis, with the intention that by October 16th, NAT would still stay below those strike prices, and then those calls will expire worthless, okay? So instead of $4, which is so close to the current price already, if I sold a $4.50 call, 5 of them for 5 covered calls, I would get a credit of only $60. If I went with the $5, I would only get $30, which is really, really less compared to what it was before. And the reason for this is because the stock has been consistently coming down. There's not a whole lot of interest left in the stock that there was before. And so a lot of the premium around the options for the stock keeps going for more and more down, okay? If you want to sell puts, on the other hand, for puts, it's the opposite of calls, where you want the price of the price of the stock to stay above the strike price, so that the put that you sold will expire worthless, okay? So I could potentially sell 3 of these 350 puts to collect $48, but I'd have to hold at least over $1,000 as cash collateral, okay? So the risk reward there is really not worth it. I could go more in the money for the $39, sell 3 of those for $117, but the cash collateral would be $1,200 for 3 puts. But either way, the risk to reward is not there anymore when it comes to just selling calls or just selling puts, okay? So I've stopped doing covered calls or cash secured puts. The only strategy that I think is worth it anymore is what are called credit spreads, okay? I briefly did talk about it in the previous video, but I just wanted to update you guys on it in case you were still curious, because some people reached out to me about that, okay? So when it comes to put credit spreads, what you do is you buy a put of a lower strike price and sell a put at a higher strike price, and you get a credit out of it, okay? And as long as the stock stays above the put that you sold, you get to keep the full credit that you got from it, okay? So let's say I bought the $3 put and sold the $3.50 put expiring October 16th, and let's say I got about 25 of those. I would get a credit of $225, but if I proceed with it, there will be a cash collateral of $12.50, which is a lot, but $225 is also pretty decent, okay? As long as it's stays about $3.50, if I can keep $225 on a monthly basis, that's not too bad, okay? On the other hand, if you want to be a little more aggressive, what you could do is, let's say you're a little more bullish on it and it'll go at least $4 by October 16th, after this little correction that we saw, you could potentially buy the $3.50 put and sell the $4 put, and now you could get a credit of $23 per put credit spread, and for 25 of those you can get a credit of $5.75 instead of just $2.25, and this seems a lot more rewarding in my opinion, okay? But again, like I said, NAT would have to stay above $4 for you to be able to keep your full premium. Okay, so just be careful when you do that. Another thing you could do is use a call credit spread, where you could buy the $5 call and sell the $4.50 call, and you would get a credit of $6 per call credit spread. And so if you sold 20 of those, if you do the math here, if you sold 20 or 25 of those, you'll get a credit of $150 for a cash collateral of $12.50 again, which is pretty less. Again, if you're more bearish on the stock and if you think it'll stay below $4, you could sell the $4 call instead and buy the $4.50, and now you get a credit of $2.75 instead of just $1.50. Okay, so these are the only strategies that I'm using right now: put credit spreads or call credit spreads, to make a smaller premium compared to what I was able to before. And I'm still continuing to do that to collect a monthly premium, and a good quarterly dividend adds on top of it, and you can more than make up for your initial investment. Okay, so another strategy on top of the credit spreads that you could use are called debit spreads. Okay, now I haven't used this myself, but I was thinking more about it, and I thought this would be good to share with you guys. Okay, so as opposed to a credit spread, in a debit spread you actually pay a certain amount to open a spread, such that you're actually expecting that the stock will stay above the call that you sold or below the put that you sold. Okay, so in a call debit spread, for example, I could buy the $3 call and sell the $3.50 call with the expectation that NAT will stay above $3.50 by October 16th. Okay, so now if I got a 25 of those, I would pay a total of $11.50, and if NAT stays above $3.50, this debit spread would be worth $50 each. So for 25, you would end up with $12.50 by October 16th. Okay, now that's just $100 profit for an investment of $11.50. So if I do the math here, 100 divided by $11.50, it's an 8.7% return in 1 month. It's not too bad, but when you're trading options and taking the risk, you ideally want a higher profit risk to reward. Okay, so let's say you wanted to be a little more aggressive and decided to buy the $3.50 call and sell the $4 call, expecting that NAT might just cross $4 by October 16th again. Now you would only pay $725 for it. And if NAT does go above $4 by October 16th, again, this would be valued at $12.50. And now your profit is more like $525 by the $725 that you invested, which is a 72% return. Okay, so that's how called debit spreads can be even more advantageous than just credit spreads. Okay, let's see how that works out when it comes to put debit spreads. So for put debit spreads, you want the stock to stay below the price of the put that you sold. Okay, so what you would do here is you would buy the $4.50 put and sell the $4 put for a total of $8.50, and if NAT does stay below $4 by October 16th, again as before, it would be valued at $12.50 for 25 debit spreads, and now you would have made a $400 profit. Okay, if you want to be a little more conservative, you could buy the $5 put instead and sell the $4.50 put, but right now the pricing is in such a way that you will not make any profit at all. Okay, so that's not even worth it at this point. So I would either go with the $3 and $3.50 call debit spread for a small $100 profit, or I'll be a little more aggressive with the $3.50 and $4 call debit spread, where you could potentially make a $525 profit. Or if it's a put debit spread, it has to be a little more aggressive to make any kind of a profit. Okay, currently this is a little more risky considering the risk to reward. Again, it's up to you guys which strategy that you do want to use, but these are the strategies that I wanted to share with you guys, either the credit spreads or the debit spreads. I'm leaning a little towards the debit spreads right now, especially now that I thought this out a little more. So whichever strategy that you want to use, please think through it, understand that there is risk involved, irrespective of which way you go with it. But if you enjoyed that, guys, please do smash that like button and leave a comment below if you have any questions. Subscribe to my channel and hit the notification bell if you haven't already. Okay, thanks again for watching, and until next time.